The price is lying, and the spread is telling the truth. And that is why this gold and silver surge isn't just another risk-off headline pop. This is a credibility run on the dollar, happening in broad daylight, while the usual gatekeepers try to frame it as emotion, geopolitics, or speculative froth. But the hidden mechanism is colder than that. It's math, it's sourcing, it's the calendar. And by the end of this, you're going to know the two levels that matter most, the one market signal that exposes stress before the chart does, and exactly what would confirm this move next week, or break it. Right now, gold has pushed to fresh record territory around the mid-4600s per ounce, and silver has been violent enough to print in the low 90s before snapping back like it hit a wall of air. That snapback is not a bug, it's the clue. Because when a market moves like it's being yanked by a cable, rip, whip, rip, it usually means positioning is being forced to adjust, not politely choosing to. And that's where the real pressure starts. Here's the first thing to internalize. The dollar losing control is rarely about one neat DXY line on a chart. It's about confidence in the framework. It's about whether global capital believes the rules are stable, whether policy is predictable, whether institutions can do their job without becoming a political football, and whether holding claims in dollars feels like holding a risk-free asset or holding a promise that can be repriced overnight. That is a completely different conversation than strong jobs data or one inflation print. And that why metals can be screaming even when the daily talking points feel like they don't justify it. Now, yes, geopolitics has been a catalyst. When the world starts pricing the possibility of escalation, you get the classic safety bid. But the more unusual part is what's happening at the same time. Base metals like copper and tin have also been hitting records. That's not the normal script. Normally, fear bids gold while growth-sensitive metals cool off. When you see both moving, you're looking at something broader. A regime where supply chains, trade rules, and political risk are merging into one giant cost of doing business premium. And when that premium rises, hard assets don't just look attractive. They look necessary. But that still isn't the hidden detail. Not yet. The real tension, the one people keep stepping around, is institutional risk. This week, the conversation around the Federal Reserve hasn't been what's the next dot plot. It's been, does the Fed still have insulation? When markets get even a whiff that the world EU's most important central bank is under direct political attack, investors don't need a lecture on history to react. They react instantly. Because central bank credibility is not a vibe. It is collateral. It's the foundation of term premiums, plus inflation expectations, and the entire pricing of money over time. If that foundation gets shaken, the price of money changes. And gold is basically a lie detector for that. But that's not the part that matters most. The next detail is what flips the whole setup. Because while everyone is staring at the headline, the signal has been showing up in how metal is moving through the system, especially the incentives to pull physical metal into specific jurisdictions before rules change. This is the underappreciated mechanism that reframes the story. Tariff front-running and physical rerouting. Not a theory, not a conspiracy, just incentives. If market participants believe tariffs, restrictions, or national security designations might land on key metals, then the cheapest, most rational trade is to move metal now, while it's clean, liquid, and cheaper to transport and finance. You don't wait for the sign to go up that says the door is closing, when you walk through the door before everyone else lines up. And when enough money does that at once, the physical market tightens in places you wouldn't expect, even if paper trading looks deep. That's how you get the strange combination of record prices, violent intraday reversals, and whispers of tightness that don't show up in a clean headline. And if you understand that, you stop asking, why are metals up? And you start asking, what is being pulled forward? Because pulled forward demand is the kind that breaks normal pricing. Now let's ground this in structure, because this crowd doesn't buy vibes. Gold and silver don't trade as one market. They trade as a stack of markets. There's spot, there's futures, there's OTC forwards, there are vault-backed products, there's physical retail, there are industrial procurement contracts, there's leasing and borrowing. And the key is this. The screen price you see is often the most leveraged, most financialized layer of the stack. That layer can move fast, it can be pushed by options and positioning, and it can sometimes print a price that physical markets can't immediately deliver at scale. When that happens, you don't want to argue about manipulation. You want to look for stress, because stress leaves footprints, and the biggest footprints are in spreads. This is why I started with the line. The price is lying, and the spread is telling the truth. In a healthy market, the relationship between near-term and later delivery, between spot and futures, behaves within a range that reflects financing costs, storage, convenience yield, and normal availability. When availability tightens or immediate demand spikes, those relationships distort. Sometimes it looks like backwardation pressure. Sometimes it looks like near-month contracts behaving like a panic button. Sometimes it looks like unusually strong bids for immediate delivery versus, sure, we'll deliver later. That's not drama. That's the market admitting there is value in being early. And if there is value in being early, you're in a phase where participants are paying for certainty. And that is exactly the kind of phase where metals can climb while the dollar wobbles. Here's the simple translation. When the front end of the curve tightens, it forces people who rely on rolling paper exposure to make decisions. They either pay up to stay in the front, or they roll out and accept they're not really in the stress trade anymore, or they go physical. And when enough people try to go physical at once, the bottleneck isn't how much metal exists on Earth. The bottleneck is refining capacity, logistics, settlement systems, and which inventory is truly deliverable to the specific venue that sets the benchmark. The difference between inventory exists somewhere and deliverable inventory here now is where the squeeze lives, but that's not the part that matters. The next part is the calendar, because the calendar is the catalyst, and this setup is running directly into it. We're not in some open-ended, low-stakes drift higher. We're in mid-January, staring at an end-of-month collision, options expiry dynamics, and a major central bank event window. When you get big moves into big round numbers right before key dates, liquidity thins and positioning becomes brittle. That's when markets stop being about fundamentals and start being about forced behavior. Dealers have to hedge, funds have to rebalance, risk committees get loud, margin requirements adjust, and suddenly what looked like a smooth uptrend turns into a jagged staircase. This week and next week are the kind of weeks where the chart can do something that feels insane and still be completely mechanical, and that's where retail gets emotionally ambushed. Let's talk about the mechanics that create that ambush, options and dealer hedging. You don't need a PhD for this, you just need one picture in your head. Imagine a big cluster of option strikes sitting near obvious levels, round numbers and fresh highs that everyone can see. As price rises toward those strikes, the risk profile of those options changes. Dealers who sold those options often hedge by buying or selling the underlying to stay neutral. That hedging isn't a prediction, it's a reflex. And in certain conditions, especially when gamma exposure is concentrated, those reflexes amplify the move. Price rises, hedges require buying. Buying pushes price higher, hedges require more buying. That's the loop. Then, once the move overshoots, or the hedging demand flips, you get the reverse, air pockets. That's how you can see silver spike into the 90s and then drop hard, not because the story ended, but because the mechanical fuel tank emptied for a moment. And if you only watch the candle, you get whipsawed. If you watch the structure, you see the engine. So what's the street symptom that tells you this is more than candle drama? It's the way physical markets have been behaving under the surface. One of the cleanest signals is premiums, what buyers are paying over paper pricing for real metal, real bars, real delivery. When premiums widen, it's the physical market voting with cash. And in Asia, there have been signs of that vote. Strong physical interest in premiums and key hubs, even while higher prices can visibly strain demand in places like India, where buyers are price sensitive and culturally anchored to gold. That split matters. It tells you demand is not one blob, it's layered. Investment and reserve behavior can be strong while jewelry demand pauses. That's normal in a new regime, but it's also a warning. Price can outrun some segments, and that creates violent pullbacks even inside a longer bull phase, and that's not the part you want to ignore. Now let's stack proof, because one argument is never enough in markets like this. Proof point one is the synchronized move across precious and industrial metals. When copper and tin are setting records alongside gold and silver, that's a sign the hard asset bid isn't isolated. Proof point two is the institutional risk premium showing up alongside metal strength. When the conversation around central bank independence heats up, the demand for neutral collateral tends to rise. Proof point three is the tariff and trade rule uncertainty creating incentives to front-run physical flows into the US stits, which can tighten availability and distort spreads. Proof point four is the behavior of silver itself. It's not moving like a sleepy store of value. It's moving like a market with leverage and sensitivity to procurement, hedging, and positioning. Proof point five is the nature of the pullbacks. Fast, sharp, and often followed by renewed bids. Classic signs of forced behavior rather than a tidy, everyone agreed to take profits moment. And if you want a sixth layer, look at the macro backdrop. In high uncertainty, real rates and currency confidence don't need to collapse for metals to run. Metals just need the market to price a higher probability of regime instability. That's a subtle but critical shift. Because if this is probability repricing, it doesn't reverse on one calm afternoon. It reverses when the probabilities change. Now, silver deserves its own spotlight because silver is where viewers get emotionally shredded. Silver is not cheap gold. Silver is a supply chain metal wearing a monetary mask. That means it's pulled by two different engines: the monetary engine that chases protection and collateral, and the industrial engine that reflects manufacturing, electronics, solar, and a whole web of physical consumption. On the supply side, silver is constrained in a way people underestimate. A lot of silver production is byproduct from other mining. You can't just flip a switch and produce more silver because price spiked. Lead times are long. Refining and assay capacity is not infinite. Recycling helps, but it can't instantly cover a global surge. That's why silver can go from nobody cares to no one can get enough, faster than your timeline can handle. And when it does, the volatility is not a sign of weakness. It's the admission that the market is small relative to the capital trying to express a view. But listen closely. This is also why silver can drop 10% in a day, even when the big thesis is right. Because it doesn't trade like a bond, it trades like a coiled spring, and springs snap both ways. So what's the hidden detail doing to silver specifically? It's turning a normal demand curve into a calendar-driven procurement curve. If there's a policy window, if participants believe a trade or tariff decision could change the cost or availability of importing metal, then buyers don't smooth their purchases over time. They bunch them, they accelerate, they pull forward. That creates temporary scarcity. Temporary scarcity creates premium. Premium attracts attention. Attention attracts leveraged paper demand. Paper demand runs into options. Options create dealer hedging. Dealer hedging amplifies the move, and then, when the move gets too extended, the same leverage that pushed it up creates a brutal shakeout. That's the entire movie in one paragraph. And once you see it, you stop being surprised by the whips. Now, I'm going to give you the part that most people skip because it doesn't sound dramatic, but it's the most actionable. The levels. Not because levels are magic, but because levels are where behavior changes. Levels are where risk managers force decisions. Levels are where options clusters create hedging pressure. Levels are where breakout traders either get paid or get trapped. And if you're watching metals this week, you're watching a market that has just printed new highs and then proven it can violently reject those highs intraday. That means the battlefield is clearly marked. For gold, the headline area is the recent record zone in the mid $4,600. That's the psychological ceiling, and the everyone sees it strike magnet. If gold can hold above the lower portion of that breakout range on a pullback, think the low to mid $4,500 as a zone, not a single number, that's what a healthy bull does. It pulls back, retests, and finds buyers. If it slices cleanly back below that zone and stays there, the market is telling you the move was more positioning than structural demand. That's an early warning. But if it holds the retest and then starts pushing back toward the highs into thin liquidity, you're in continuation territory, and continuation in a record zone is where gaps happen. Because if this one level breaks, the math changes. For silver, the key is even more psychological. The $90 handle region is a billboard. Breaking above it matters because it forces reevaluation. Rejecting it matters because it triggers "it was a blow-off" narratives. This is where people get manipulated. If silver can stabilize above the upper 80s after pullback, again, zone thinking, not precision worship, that's constructive. If it loses that zone and starts living in the low 80s with heavy selling, it suggests the spike was dominated by leverage unwinding. But here's the twist. Even leverage unwinds can be bullish later because the market clears weak hands and reloads. That's why you need the next week checklist, not the emotional story. And speaking of next week, here's the two scenario lens you must use if you want to stay sane. Scenario 1 is controlled pullback and retest. In this scenario, gold and silver cool off, volatility stays high, but becomes more two-way, and price tests key support zones while spreads and physical signals stay firm. Confirmation looks like dips getting bought faster than rallies get sold, and no collapse in the induced stress thermometer signals, meaning the market doesn't suddenly behave like immediate metal is abundant and nobody cares about prompt delivery. Invalidation looks like sustained breakdown below the breakout zones, along with a visible easing of physical tightness signals and a normalization of front-end urgency. In other words, the market stops paying for certainty. That would be a regime shift back toward paper comfort. Scenario 2 is continuation squeeze with gap risk. This is the one that makes people either euphoric or traumatized. In this scenario, price pushes back toward highs into the calendar window. Options dynamics, policy headlines, thin liquidity, and the market climbs a wall that feels too steep to be real. Confirmation looks like sharp dips getting instantly reversed, price holding above the retest zones, and the market repeatedly refusing to stay below key levels even when headlines try to scare it down. Invalidation looks like a blow-off followed by a failure to reclaim, meaning you spike, crash, and then every rally gets sold below the prior highs, turning the whole thing into a distribution pattern. And that S, the part that matters. Continuation squeezes Danti end when they feel scary. They end when they stop being defended. Now I want to zoom out and talk about why institutions behave differently than retail here, because this is where audience trust gets built. Big money doesn't T-buy gold and silver because they think it will go up next Tuesday. A lot of structural buying is about reserves, balance sheet hedging, and collateral preference. Central banks in recent years have shown a willingness to accumulate gold as a reserve asset, not because they're trying to beat a benchmark, but because they're managing long-term sovereignty risk. That type of demand doesn't vanish because a candle turns red. Meanwhile, investment flows into bullion exposure can surge when narratives shift toward instability, and those flows can persist longer than retail expects. But those flows are also capable of pausing suddenly if volatility becomes too high or if policy risk looks like it's being resolved. This is why you do not marry one narrative. You watch behavior, but that's not the part that matters. The part that matters is how volatility will be used against you. Because here's the dirty secret of markets like this. Even if the thesis is right, price can whip around violently. The market can be structurally bullish and still punish you if you confuse noise for signal. The people who get wrecked in metals aren't the ones who are wrong about gold. Us, they re the ones who get emotionally hijacked by a 6% drop after a 20% run and decide the story ended. Volatility is a weapon. It's designed to make you buy high when it feels safe and sell low when it feels urgent. It whispers, "You're late," at the top and screams, "Get out now," at the bottom. And the funniest part is the same commentators will narrate both moves like they were obvious. That's why you need a psychology shield. Here's your shield in plain terms. First, separate trend signal from noise. Trend signal is the market holding key zones, being defended on pullbacks, and maintaining structural stress signals like front-end urgency and persistent demand. Noise is intraday chaos, headline-driven spikes and sudden reversals into thin liquidity. Second, pre-decide what would make you change your mind, not what would make you feel scared, what would objectively invalidate the setup. If you can't say that in one sentence, you're trading emotion. Third, respect that metals can gap, silver especially. If you can't tolerate waking up to a move that skipped your stop, you must size accordingly. That's not fear-mongering. That's respect for how these markets actually behave when liquidity thins and leverage is involved. And that's where the real pressure starts, because the market doesn't care about your comfort. Now let's talk counterpoints, because credibility means you can say, "Here's how I could be wrong," without losing conviction. The cleanest way this rally could cool is if geopolitical risk rapidly de-escalates and the market decides the tail risk premium was overpaid. Another is if the institutional risk narrative around central bank independence fades, either through legal clarity, political cooling, or simply a shift in attention that reduces perceived probability of interference. Another is demand destruction, especially in price-sensitive physical markets, where high prices cause enough slowdown that the physical bid softens. Another is a dollar rebound fueled by growth or capital flight into U.S. assets for reasons unrelated to trust. And finally, positioning itself can become a counterpoint. If the market got too one-sided, the unwind can be brutal even if the long-term story survives. None of these counterpoints require a grand explanation. They're normal. The question is whether they actually show up in the signals that matter. Because if the mainstream story changes, but the stress thermometer stays hot, then the mainstream story is just commentary. So what should you watch? Specifically, right now, today, this week, watch the behavior around the recent highs. Markets that are breaking into new territory tend to do one of two things. They either consolidate and build a base, or they V-reversal back under the breakout and trap late buyers. If you see repeated attempts to break higher that get rejected, but the pullbacks keep getting bought above key zones, that's not weakness, that's digestion. If you see a clean break below key zones and the market can't reclaim them, that's a different movie. But there's another detail that flips the whole setup. Watch the difference between calm price action and stressed spreads. If price goes sideways while stress signals persist, that's coiled spring energy. If stress signals relax while price is still high, that's a warning that the move was more financial than physical. And that's the part that matters. Now you might be thinking, okay, but what comes next? Give me the roadmap. Here it is, tight and practical. Over the next 1 to 2 weeks, you're watching a tug of war between calendar mechanics and narrative volatility. You're likely to see at least one attempt to scare holders out, an ugly red day, a headline bomb, or a liquidity flush that looks like the end. If the thesis is intact, that flush should find buyers in the key zones, gold defending the low to mid 4500s area, and silver defending the upper 80s area after any pullback, with the market showing an unwillingness to stay weak. If instead those zones break and stay broken, and the market starts acting like immediate metal is no longer scarce, then you shift into cool-off mode and stop expecting straight line upside. Either way, you don't need to predict. You need to react to evidence. And let's be honest about risk, because this audience hates sugarcoating. This is not a guarantee trade. This is not easy money. This is a high volatility regime where even correct macro calls can be punished by timing mistakes. Gold can drop hard after making a high and still be bullish on the month. Silver can rip your face off in both directions. If you treat a pullback as proof you were wrong, you're going to get chopped into confetti. If you treat every green candle as proof you were right, you're going to chase and puke at the worst time. The only way to survive is to decide what you're actually trading: a short-term move into the calendar window or a longer-term regime shift in monetary confidence. Those are different time horizons. They require different expectations. And mixing them is how people get emotionally manipulated. Now, I want to circle back to the hidden detail one more time, because it's the keystone. When rules might change, the market pulls forward behavior. Physical metal gets moved. Inventory that was available becomes allocated. Logistics become a bottleneck. Price discovery starts feeling less like a smooth auction and more like a scramble. That scramble doesn't require anyone to be evil. It just requires everyone to be rational under uncertainty. And that's why the phrase, "the dollar loses control," lands so hard here. Because control in markets isn't about authority, it's about confidence. When confidence wobbles, hard assets don't ask permission. They reprice, quietly at first, then loudly. And then everyone acts like it was obvious. But that's not the part that matters. The part that matters is whether the next dip gets bought. So here's the checklist. Your next week checklist. The one that keeps you from getting hypnotized by noise. 1. Does gold hold the breakout neighborhood on any pullback instead of collapsing back under it? 2. Does silver stabilize above the upper 80s after its inevitable whipsaws instead of living back in the low 80s with no defense? 3. Do you see ongoing signs that the physical market is still paying for immediacy, premiums, urgency, any hint that prompt availability is still prized, rather than relaxing into comfort? 4. Does volatility spike and then get absorbed, or does volatility spike and then cascade into a sustained unwind? 5. Into the calendar window. Do we see acceleration into highs that suggests reflexive hedging and forced behavior? Or do we see sluggish rallies that get sold instantly, suggesting the fuel is gone? If you watch those 5 things, you won't need 100 hot takes. And here's the subtle CTA, because I'm not here to beg you for anything. I'm here to build a crew of people who can think clearly when markets try to cloud your brain. If you're the kind of investor who wants mechanisms, not hype, if you'd rather understand what forces participants to do than memorize headlines, then stay close to this setup. Because the next week is going to test everyone's conviction, and most people will get played by the same old volatility script. Don't be most people. Watch the structure, watch the spreads, watch the calendar, and above all, decide what would actually invalidate you before the market tries to decide it for you.